Just walk me through your perspective on the price action this week and where it leaves us.
Look, it's been a wild week. We've seen a round trip in 10-year government bonds of like 23 to 24 basis points, starting off selling off as soon as the election started, and then rallying, and then ultimately selling off a little bit today post payrolls. I think it's important to take a couple steps back here and sort of say, look, what is going to be the final outcome? It looks like Biden's going to win. It looks like the Republicans are going to control the Senate. Gridlock is likely here to stay. Depending on what happens if runoff elections in Georgia. But ultimately, I think that's a positive for the markets because it means that the tax consequences probably won't be as severe. The likelihood of a Green Deal passing is likely not going to happen. And ultimately, both sides are going to have to get together and work towards the greater good of getting us through this COVID crisis.
Bank of America had a note out saying that they are recommending shorting the 10-year at 76 basis points. They're saying that they think that the post-election rally really is an overreaction. What do you think of that call?
Look, I think that, 10-year rates can sell off, but ultimately there's going to be a lid put on rates, whether that's done by the Fed through yield curve control, or it's done by the market. Because if you look globally where yields are trading, the U.S. is going to stick out as very attractive for foreign investors. Japan has negative interest rates. Europe has negative interest rates. Other countries are saddled with very, very low interest rates. So ultimately, that's going to be a buying opportunity. Ultimately, I think that the Fed, they understand that they can't handle, that the economy can't handle higher interest rates. It'll be a burden on the economy. It will destabilize growth. And I think ultimately what you'll see is the focus of the Fed sort of re-engineer some of their discussions around yield curve control, keeping a cap on interest rates, maintaining that dovish stance.
So if I want yield, where do I go, Nick? Do I go to equities or where else can I go?
Yeah, I mean, equities, you would have made your a year or even two by owning equities this week compared to bonds, right? So that's kind of the predicament that we're in the fixed income market. There's really two things that we know about the fixed income market, right? The Fed is backing credit and the Fed is on hold. And that stands for all central banks. No central bank is going to be raising interest rates anytime soon. In fact, the bar to be raising interest rates is higher than it's ever been. We're talking anywhere between 3 to 5 years before we see any interest rate hikes. So what does that mean? Focus on the front end. Yes, the yield isn't that attractive, but it's safe. You don't have the volatility that you do by owning the back end. You got the rally earlier this week. You got the sell-off today. Front end's not moving, and that's because the markets are pricing in these central banks to remain on hold. So if you can focus on some yield in Australia, Canada, even the US, and also combine that with investment grade credit, you're not going to get 5, 6, 7% from fixed income, but you will get a decent income stream.
So how do you see the environment shaping out in terms of central bank and then also government fiscal policy? If here we're looking at a gridlock government, you may not get the big fiscal bang everyone was expecting, but then you do get the Fed versus over in Europe, you're still getting both. How does that inform your trades?
So for us, Alex, the Fed is the only game in town. Politicians change. We all know that every 2 to 4 years. What's been the only constant over the last 2 decades? The Fed. Greenspan, Bernanke, Yellen, and now Powell. They all sing the same tune. They're all extremely dovish. Dovishness has zero political limits. So ultimately, the Fed policy is going to be what's driving markets. And I think the market actually understands that, which is why you've seen such a bid in risk assets. Ultimately, they're there to backstop that. We're going to get another stimulus package. I'm not sure if it's going to do the trick and sort of bridge us to the end of this crisis. But ultimately, like I said, the only game in town is the Fed, and that should be the primary focus, not necessarily who wins the election. It's how the Fed reacts to that.
Nick, I had the chance to talk to the Governor of the Bank of England a little earlier on this week, and we were talking about tools still left in the box. There is this consensus that the toolbox is pretty empty right now. The sense I got from the Governor was it's not. There are other things that can still be done. How empty is the box? How far can we still go with central banks in terms of their creativity?
So you're right, Guy. The consensus around central banks is that they're at their limits, but our belief is that they're really far from that. Central banks are going to stop at nothing to keep risk assets elevated and also provide an environment that can bridge the gap between now and the end of the crisis. And I think that we're much closer to the end of the crisis than we are at the beginning, so that's a positive sign. Ultimately, positive news will prevail, and that will actually lead us, so I guess, to the promised land, for a lack of a better term. But I guess my point is that don't underestimate the Fed. don't underestimate these central banks. Yes, every round of quantitative easing that comes about has a less and less effect on the market, but it's still there to provide support. And ultimately, if you look at the Fed, what they can do is they can start buying other assets that they haven't decided to purchase yet, whether that moves down into high yield, structured assets, some more liquid assets, and the Bank of England and other central banks can likely do the same.
Rounding it out here for this segment, some rhetoric is that, look, EM's the safe haven. Go buy it. You're going to get the yield. You're going to get the safety. You're less tied to the U.S. election. If Biden wins, it's only upside. What do you think?
You know what, Alex? It's a tough one because I think certainly EM offers that yield advantage. But in a risk-off move, EM, emerging markets, is going to behave like risk assets. So in our view, it doesn't necessarily provide a diversification story or that income protection should things intensify or get worse. But it does provide a yield advantage over, let's say, treasuries or investment grade credit to some extent. The problem that you have with EM is that it's sort of like the tail that wags the dog, right? What happens in the US or some of these larger economies is really going to sort of dictate what happens in EM. So I think the jury's still out there. I think it's a good investment. I think personally, we would be focusing on regions like Asia, ex-Japan, so China, Singapore, Hong Kong, very strong nations with very strong balance sheets, as opposed to some of the other more, I guess, difficult to understand EM countries in, let's say, South America or even Eastern Europe.